The Asia Open is hours away, and right now, sitting between the Eastern and Western silver markets, there is a $4.4 gap that the market has not closed. That gap is not a data anomaly, it is not a rounding difference, it is a price signal, and if you hold silver in any form, physical, paper, allocated, or in a SIP, what happens when Asian markets open tonight could matter directly to your position. Last week, I told you to watch the US 10-year Treasury yield against the 4.5% level as my one specific call. I said a hold below 4.5% kept the silver setup intact. The yield came in at 4.39% and held there. Silver held the $67.95 level, and both calls held, that is 242 on the accountability loop, and I want to be transparent about that because this channel only works if you can track my calls in real time and judge them honestly. Tonight's video is a little different from our usual format. Rather than a full weekly breakdown, this is a specific pre-open briefing focused entirely on the one mechanism driving silver right now and exactly what to watch for when Asia opens. My name is John, 15 years in currency and commodity markets before I ever picked up a camera, and I have watched pre-open setups like this one play out many times, sometimes delivering exactly what the spread implies, sometimes not. Everything I show you tonight comes from publicly available data, and I will name every source as we go. If this kind of calm, evidence-based briefing is what you have been missing, hit the like button right now, and if you are not subscribed, tonight is exactly the kind of video this channel exists to make. Here is what this briefing covers: the mechanics of the $4.4 Shanghai premium and why it is pulling physical silver westward, what the LBMA and COMEX drain looks like in real terms and why the UK angle is being underreported, the specific triggers to watch at the Asia Open, and the honest bull and bear case with no thumb on the scale. Silver spot is sitting at $67.95 as we head into the weekend close, while the Shanghai metals market is quoting physical silver delivery at $72.35, a $4.4 gap, 6.47% more for the same metal physically delivered in Shanghai versus the global spot price. That number is not just interesting, it is structurally significant in a way that makes this weekend different from a typical pre-open setup. The $4.4 premium means a professional arbitrager can buy silver at the Western spot price right now, arrange physical delivery, ship that metal to Shanghai, and deliver it into the Eastern market at a profit of $4.4 per ounce minus freight and insurance. That is a real executable trade, not theoretical, and as long as that spread remains wide enough to cover logistics costs, that trade gets done repeatedly by multiple counterparties simultaneously. Every single execution removes physical silver from a Western vault, either LBMA in London or COMEX in New York, and deposits it into the Shanghai system. The question for tonight is not whether this mechanism is real, the question is whether it has built up enough pressure over the past several sessions that the Western paper price has to move to reflect it when liquidity returns at the Asia Open. Drop a comment right now. Are you positioned in silver going into this weekend? Close, and are you holding physical, paper, or both? A 6.47% premium sitting above all structural factors, taxes, financing costs, import duties, is a different animal from a local market structure premium because it is being driven by physical demand outpacing available supply at current prices. When I pulled up the LBMA vault figures and the CME warehouse report heading into this weekend, the picture is consistent with what a multi-session arbitrage drain looks like. COMEX registered silver inventory has been declining and the LBMA has been showing outflows consistent with metal moving eastward. For UK investors specifically, this is not a distant story about American futures markets. The LBMA sits in London, and the silver being pulled toward Shanghai is leaving London vaults. If you hold an allocated silver account through a UK provider or have silver exposure through a SIP, the physical inventory backing those positions is operating in the same system being drained. Think of it like a reservoir feeding two towns. One town suddenly increases its draw rate significantly. The reservoir drops faster, and the other town's supply situation has changed even though it has not changed its own usage at all. That is the relationship between the Shanghai premium and Western vault inventory right now. Western futures shorts are currently getting protection from a dollar near the 100 level. A stronger dollar makes dollar-denominated silver more expensive for international buyers, which can suppress demand just enough to keep shorts from panicking. If the DXY breaks above 100.5 at the Asia Open, that dollar strength could temporarily neutralize the Shanghai premium by making the arbitrage maths less attractive in non-dollar terms. That is a real risk, not the base case, but it is live. If you know someone who trades silver actively and is trying to make sense of this weekend setup, share this video with them right now. The people who need it before the Monday Open are probably not finding it through the algorithm. The 10-year Treasury yield at 4.39% is doing something specific in this setup. If yields retreat on Monday, silver could see a move of $3 to $5 to the upside, because when Treasury yields fall, the dollar typically softens with them, making dollar-priced silver cheaper for international buyers, including the Shanghai buyers already paying a premium. Those two forces, yield retreat and dollar softening, arriving together at the same moment as the existing physical premium pressure, is what creates conditions for a gap-up move rather than an ordinary drift higher. $325 on a $67.95 base is a 4.4% to 7.4% move in a single session. I want to be precise that the article presents this as a scenario, not a certainty, and I am presenting it the same way. In 15 years watching these markets, a 6.47% physical premium between two major settlement hubs is the kind of structural pressure that does not dissipate quietly. It either resolves through the paper price moving to close the gap or through the physical premium compressing as supply constraint cease, and right now with vaults being actively drained, the easier resolution path is the paper price moving. The geopolitical backdrop adds one more layer. The Iran situation is creating a broader safe haven bid across precious metals, with gold holding $4,500 against rising yields and silver holding $67.95 with a 6.47% premium screaming at it from Shanghai. That combination safe haven macro bid plus physical arbitrage pressure is what makes this particular weekend setup more loaded than a typical pre-open situation. The paper lane, the DXY at 99.65, is the current cover for Western shorts, and open interest in silver has been declining, which means the market is thinner than normal and thin markets move faster in both directions. If Asian buyers come in with size at the open, there are fewer counterparties to absorb the order flow, which amplifies the move. The physical lane, the $4.4 premium, the LBMA outflows, and the declining COMEX registered inventory are not this week's numbers. They are the result of a multi-session drain that has been building, and the physical picture is not neutral going into this open. It is already under structural pressure. The macro lane, the 10-year yield at 4.39% is below the 4.5% danger level I called last week. The dollar is near 100 but has not broken through, and the geopolitical bid is active. In 15 years watching these markets, when I have seen a physical premium of this size combined with thin paper market positioning and an active macro bid, the Asia Open has been the moment that either confirms the setup is real or reveals that the spread was masking a structural problem, when the physical lane is showing a 6.47% drain signal while the paper lane sits thin and the macro lane has an active geopolitical bid. The historical pattern has been that the paper price does the adjusting, not the physical premium. That is a framework, not a forecast. You decide what to do with it. Here is my one specific call for this open. I am watching the $70 level on silver at the Asia Open. $70 is psychologically and technically significant. It is the midpoint between current spot and the Shanghai price, and it is the level where short covering would likely accelerate as traders calculate that the premium is not going away. If silver opens above $69.5 in Asian trading and holds that level into the first hour, the gap-up scenario is developing. Watch for volume confirmation, because a move on thin volume is less meaningful than a move with genuine participation. If silver opens flat or lower and the DXY pushes above 100.5 in the first hour, the bearish scenario is developing. The premium does not disappear, but gets temporarily suppressed by dollar strength, and the resolution gets pushed to later in the week. This is my one call for this open. John FX Insider, on record right now, and the follow-up video will be the first thing I publish when the dust settles. No edits, no revisionism, exactly what happened against exactly what I called. For the optimistic picture, Asia opens with heavy physical buying, Western futures gap up toward $70 as shorts are forced to cover. The 10-year yield holds at or retreats from 4.39%, softening the dollar and amplifying the move, and the DXY stays below 100.5, removing the main cover for Western shorts. In that scenario, silver closes the gap with Shanghai significantly in a single session, and the broader squeeze narrative becomes impossible for mainstream financial media to ignore. For the cautious picture, the DXY breaks above 100.5 at the Asia Open, neutralizing the arbitrage economics. Yield expectations shift hawkish, keeping the dollar firm and capping the silver move, and physical demand in Shanghai moderates, slightly narrowing the premium to a level that no longer creates urgent arbitrage pressure. Silver holds the $67 range but does not gap higher, and the resolution is slow rather than sharp. Anyone who tells you they know which scenario plays out on a weekend pre-open briefing with geopolitical variables in play is not being honest with you. But when Asian markets open, you will know within the first 2 hours which path the market has chosen. Before we close, everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here is a recommendation to buy, sell, or hold any asset, and past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. That disclaimer is not a formality, it matters. If this briefing gave you clarity heading into the open, the like button takes 1 second and genuinely helps this channel reach people navigating these markets without the noise. I want 2 honest answers before we close. First, are you making any changes to your silver position before the Asia Open tonight, physical, paper, or both? Second, do you think the $4.4 premium closes this week through the Western price moving up or through the Shanghai premium compressing down? Subscribe. The follow-up to tonight is coming as soon as the Monday session gives us a clear picture, showing you exactly what the open looked like against the setup I just described. And if someone in your life is watching their silver stack this weekend feeling uncertain about what is coming, share this with them right now. Not after the open. Now, this is Currency Insider. Know the market, protect your currency.